Dear viewers, 2022 was a big speed breaker for buy at any price and growth at any price investors. With the cheap money out of the picture, a lot of high-flying stocks saw the wind beneath their sails disappear. However, the sentiments are shifting again. From a big sell-off in March this year, the small caps have rebounded, and how? The small cap index is now flirting with all-time highs. For individual small caps, the upswing has even been higher. You see, that's the nature of small caps. When sentiments are adverse, they take the hardest knock. When the markets are upbeat, a slightest nudge could send them soaring. It's good to see small caps rising, but this comes with a sense of caution. For markets are cyclical, and there may be a point when the valuations run ahead of fundamentals. So how close or far are we to that point? While this mark would be different for each business depending on its fundamentals and stock price, let me share my views on small caps in general. Now let us first check the general market sentiments. At present, Sensex is just 1% shy of its lifetime high. It is trading at a PE of 23.2 times, a level which is saner than the peak of 36 times in 2021, but at a premium to its long-term median of 20.2 times and not too far from some of its previous peaks. Now here is a very simple conservative or base case prediction for Sensex in the next 5 years. You see, Sensex earnings have grown at a CAGR of around 13% over the last 2 decades. Now if I expect the earnings to grow at the same rate over the next 5 years and use a median PE multiple of 20.2 times, the Sensex could be close to 96,000. That's close to 1 lakh, and let's take that number for the sake of simplicity. Now let's see what the implied upside for the small caps could be from the current levels. Unlike Sensex or BSE 30, the PE ratio for small caps does not make sense. That's because over 4,000 stocks fall in this category, a lot of which are loss-making or junk stocks where earnings is a non-meaningful concept. So for the lack of a sensible PE number, let us use another metric, small cap to Sensex ratio. The ratio of small cap to Sensex index at present stands at 0.49 times. Now this compares to previous peaks ranging from 0.54 to 0.76 in the last 2 decades, which means that there is still room for small caps to rise before investors turn fearful. Now if I have to make a projection for small cap index, I'll use a medium small cap to Sensex ratio and a base case projection for Sensex. Now since the base case prediction for Sensex is 1 lakh in 5 years, the projection for small cap index using this median of 0.44 comes to around 44,000. Now this compares to a current level of 31,000. So there is upside in the small caps even in the base case. However, at current level of 0.49 times, the small cap to Sensex is at a premium to long-term median of 0.44 times. You would not find enough low-hanging fruits in small cap space. If you are not diligent and selective while picking stocks in this space, your investment journey could be doomed. That said, in my view, it does not make sense to wait on the sidelines yet, but invest in quality small caps that offer enough comfort on sustainable growth over the next 3 to 5 years. At the same time, it's a good time to use this momentum for profit booking in some cases where the growth prospects and balance sheets do not support valuations. Some indicators that I pay attention to include looking if the cash flows are in alignment with earnings. While earnings can be manipulated easily, such as with depreciation policies, capitalizing recurring expenses, changing inventory policies, and so on, it is difficult to manipulate cash flows. A consistent divergence deserves some digging in and due diligence. While cash flow from operation could be a bit out of line with earnings depending on the nature of the industry, a peer comparison and comparison with the past trends could be very insightful. I prefer stocks with positive cash flow from operations. Further, for non-banking stocks, I prefer businesses where debt-to-equity ratio is less than 1. That's because I like the businesses that can carry growth in a self-sustainable manner. Now, while a lot of investors pay attention to profits, few are conscious of returns generated by a business. A business, let us say X, that requires an investment of Rs 100 and earns a revenue and profit of Rs 50 and Rs 20 respectively, is likely to have better economics as compared to another business Y that needs investment of Rs 500 and generates revenue of Rs 50 and a profit of Rs 25. For X, the profit margin is 40% and return on capital invested is 20%. For Y, the profit margin is 50%, which is higher, but the return on capital employed is just 5%, which makes it a poor business as compared to X. As such, it is not the profit margin but ROCE, which is a better indicator of returns that you will make on an investment. Lastly, check out how valuations fare as compared to long-term median valuations. For instance, PE of the same stock as well as of the peers in the industry. Now do check out my video for Balaji Amines and Alkyl Amines where I spoke of a potential case of a valuation arbitrage. You could check the link below this video only. Lastly, long-term investors should approach investing like business partnership. The stocks as such are to be treated not just as price tickers moving up or down, but real businesses, the prospects of which could be made or marred not just by the competence of the management, but also by their integrity and focus. Now avoid stocks with a very high promoter pledging, as this weakens the management control on the business and could lead to selling pressure amid bearish sentiments on the stock. Now based on the criteria I've just shared with you, I'll now share a watch list of stocks. These stocks have also witnessed insider buying in the month of May. By the way, do check out my video on insider buying further to filter stocks on this parameter. But moving on to today's watch list, the first on this list is Anup Engineering. Demerged from Arvind Limited in 2018, the company's product portfolio includes heat exchangers, reactors, pressure vessels, columns and towers, industrial centrifuges and forged components. Heat exchangers alone account for over 70% of the revenues. Now these products find applications in diverse industries such as oil and gas, petrochem, LNG, fertilizers, chemicals, pharma, power, water, paper and pulp, and aerospace in India and export markets, with domestic contribution to sales at 81%. Now given the nature of its products, the business is likely to be beneficiary of capex revival. To capitalize on this, the company has expanded capacities while keeping the balance sheet debt light. As compared to a revenue of Rs 4 billion with the operating profit margin at 20%, the order book for the company in FY23 stands at 5.3 billion rupees. The management guidance is 25% to 30% CAGR growth for 2 to 3 years with annualized EBITDA of 20% and the share of exports expected at 30% from 19%. The debt to equity is well within the comfort zone and 3-year average ROE or return on equity is at 15%. The dividend payout for the stock stood at 29% in FY23. The stock is trading at a PE of 28 times and a price of 1460 as I record this. The insiders have bought the stock in the month of May at Rs 1400. The second stock on the watch list is PSP Projects, a Gujarat-based construction company offering a diversified range of construction and allied services across industrial, institutional, government residential and residential projects. It is associated with Surat Diamond Bourse project, which is the world's largest building on a single basement, and prestigious projects like Kashi Vishwanath Corridor. The management is tech-savvy and has been fast in adapting new and faster ways of construction like precast facility. From just Gujarat, the company has successfully diversified into other states such as Rajasthan, Karnataka, UP, Maharashtra and New Delhi. Now with a robust balance sheet and access to capital along with strong track record of executing signature projects, the company is well placed to gain market share in its industry, especially as weaker and unorganized players get shunted out of the market. The debt to equity is at 0.2 times. The average return on equity over 5 years is above 20%. Over last 5 years, the company's revenue and net profits have grown at 21% and 16% CAGR respectively. With the completion of Surat Diamond project, the company is now eligible to bid for high-value projects of up to Rs 25 billion. In FY23, its order book stood at Rs 51 billion with an almost 90% jump in the order flows. This order book of 51 billion compares to a revenue of 19 billion rupees in FY23, thus giving a good visibility of revenues in the near future. The company's balance sheet is robust and return ratios look attractive. It has one of the best working capital cycle of 41 days. The stock is available at a PE of 19 times and the insiders have bought the stock at Rs 747 in the month of May 2023. The third is GNA Axle. It has a market share of over 50% in supplying rear axle shafts, spindles and drive shaft to domestic tractor and CV segments. Over 50% of the revenue comes from export markets like US, Europe, South America, Japan, UK, France, China, and Australia. The business has shown strong resilience amid challenges like lockdown, steep increase in raw material prices such as steel. Historically, the fortunes of the company were linked to tractors and CVs. It has recently entered categories like LCVs and SUVs. Now, within India, from a mere 15% share of the domestic passenger vehicle industry, the share of SUVs have jumped to 40% in FY22. The share of SUV segment is expected to continue to grow further as customer preferences tilt towards compact SUVs from sedans. Hence, entry into this space is not just positive for profitability but also de-risks the business from an overdependence on a specific category of vehicles. The business is also likely to benefit from scrappage policy in 2021 due to replacement demand. Within India, tractors are also likely to be in demand with an uptick in the infra and capex cycle, and as a key supplier, GN Axles is likely to benefit from the same. However, the key risks to watch out for are client concentration and a down cycle in the CV and tractor industry. The return ratios of the company are above 20%. The stock is trading at a PE of 12 times. The insiders have bought the stock at a higher price of over Rs 800 in 2023. Now do note that the inclusion in this list does not imply a view on the stock. For that, you will need to conduct your own due diligence. With this, I have come to the end of the video. If you found it useful, let me know through your likes and comments. Do subscribe to Equity Master YouTube channel for more such updates. Thank you for watching. Goodbye.